Here we are working on a pretty good day for stocks, led by the Russells, up 1.5%. NASDAQ, as the tech beat goes on, we try and work back towards those record highs. Yes, we're watching the Middle East, and we are watching rates as well, but frankly, none of those things are really tempering the bullishness. Deutsche Bank, 8,000. 8,000. They reiterate their year-end target today. They hiked their earnings estimates, and that really is the story. A market carried forward by earnings. Truist Keith Lerner, Joe, says the bull still deserves the benefit of the doubt. Based on economic conditions, earnings, valuations, and price trends, the weight of the evidence still supports giving this market the benefit. Moreover, record highs are a characteristic of bull markets, and the recent rally is underpinned by solid fundamentals. That pretty much underscores the story, doesn't it?
Yeah, I think what's interesting is in your opening remarks, you mentioned the Russell leading the market higher. And today you have the price of oil down by nearly 4%. And we're getting some relief from oil. And guess what? That helps out the areas of the market that actually haven't been participating so far this quarter, like value as a factor, like some of the consumer discretionary names. So without question, this rally that we have witnessed in the current quarter, it's built upon momentum, which is up nearly 20% in the quarter. It's built upon semiconductors, which are up nearly 35%. And it's built upon the staggering growth that you're identifying. But guess what? Even more than that, if we could get oil prices lower, now you bring back that broadening narrative, and that's pretty interesting when you hear about an S&P 8,000 target.
Yeah, I mean, the sector performance over the last month, it's obviously top-heavy tech and comm services, 18 and 16.5% respectively. Discretionary is 14. Amazon obviously playing a large role in that because over the last month, that name has ripped by nearly 40%. But, Steph, the story is earnings. Q1 earnings growth is 28%. And at the very top of the stack, comm services earnings growth, 55%. Technology earnings growth, 52%. Discretionary, again, I'll throw Amazon in there with a heavy weighting. It's 38%. Materials quite well also. And then it sort of steadily declines from there as you get a little bit lower.
Yeah, so the broad base feels good. I know it's very much technology, but it's other stocks too. So the top 5 names so far, Micron, Valero, Ford, Nucor, and Travelers. I mean, that's pretty diversified if you ask me. But I think more impressively is earnings not only 28%, sales growth is 11%, and we're seeing margin expansion of about 100 basis points. That is very encouraging, especially in light of higher commodity costs for many, many companies. So we go back to why is it all happening? It's because the Atlanta Fed tracker now is running at 3.7%. It's been all over the place, Scott. Pre-war we were 5.3, then we got down as low as 1.3. Now we're at 3.7. So it's directionally getting better. And I think in the face of all this unknowns, it's very impressive how much we've rallied from the March 30s lows.
Oh, it sure is. And estimates, Surat, keep going up for earnings. That's part of the point here, too, is that earnings growth for Q2, 22%. For Q3, 23.5%. For Q4, 21%.
Yeah, and I think that's providing this foundation for this market, because I think going into this quarter's earnings, we all knew earnings were going to be pretty good, but what were companies going to say going forward, given with all the macro issues, the global issues? And I think what you've come out so far is companies basically saying guidance is going to stay, we think earnings are going to improve, operating margins are improving, and I think that's providing this tailwind to this market.
It'd be nice if you had, I guess, a little more broadening, Josh, wouldn't it? I mean, obviously, technology stocks have just outperformed everything else. The gains from the March lows, for example, Alphabet's like up 42%, Amazon 37%, NVIDIA almost 20%, et cetera, et cetera. And we told you about the sector performance with tech and comm services leading the way. However, only 53% of S&P names right now are above their 50 and 200-day moving averages. And the equal weight S&P 500, the RSP, is coming off its 9th down day in 10. What do we make of all of that? How do you put that into context about what's really happening within this market?
Yeah, I think it's a great observation. I think it's important for people to have the context of not just, all right, the market's rallying, but like we're in earnings season, and we already knew going in the standout earnings growth performers were mostly, not all, mostly going to be concentrated in and around the AI capex theme. It's the whole economy right now. So look, there are times where we have an economy that's driven by this phenomenon, that phenomenon. Sometimes it's a big tax cut. Sometimes it's, some sort of an industrial boom. Sometimes it's the housing market. It's the AI capex story. That's what's going on. That's what the leaderboard of the S&P 500, for the most part, reflects. Doesn't mean that we don't have stocks going up in healthcare, because we do. Doesn't mean we don't have stocks going up in consumer discretionary, because we do. But the vast majority of the gain that we're getting on profitability, it's coming either directly, like these freak show memory chip stocks, which nobody should think they'll ever see anything like this ever again happen overnight. But even putting that aside, when you listen to the commentary coming out of the Caterpillars of the world, we have this moment where people are building very large-scale projects, and that's engaging some of the most important companies away from tech as part of that. And I'll throw utilities in there. So that's what's driving the earnings growth. That's what's driving the economy. That's what's driving investor enthusiasm. So that separation that you described, Judge, nobody should be surprised by it if we think that earnings are the most important ingredient into what makes stock prices move.
Making some people certainly nervous. Julian Emanuel, who's bullish. The market was with me yesterday on Closing Bell of Evercore and raised his earnings estimates, but said there's a lot of similarities in some of the things that he's seeing in this market between today and 99. I mean, Josh talks about what's happening with Micron and some of the memory names. Show Micron again today. I mean, it's like every single day. 12% today.
Not normal.
Intel, Intel had the feel as though it was, if not, back it up a lot longer. So it's up 14 here, but I don't know, a few years. Intel had this feeling within the marketplace among the investing community is like this thing was on the outs with its nose pressed against the glass and it was never getting into the party. Government takes a stake, and all of a sudden this is now a major data center play. And I don't know how you would characterize that move from, 40 to over $100 a share. But are these things that need to be time-stamped? Because I've got people who are messaging me saying this is now the theater of the absurd, and it's not going to end well.
I think that you could clearly identify areas of the market where that's an accurate statement. And I think the market has excessive speculation for sure. Do I think there's universal excessive speculation? Not to the degree that we saw it in the late 90s. And I think the pre-existing condition that kind of benefits the environment now and allows for this earnings growth is these Mag 7 companies came into the AI build-out incredibly cash-rich, which was a much different situation than you saw in the 90s. The cash was sitting on the balance sheet. The cash was available for them to invest the capex in AI itself. So I think that's obviously a positive condition that when you try and compare it to the late 90s, I think it's a different circumstance. I do think, in general, a lot of people like to make this binary assertion. Okay, it's the 90s, it's not the 90s. Well, if there's anything in your portfolio where you feel as though there could be a similarity to the 90s, then guess what? You're overexposed.
No,
you're intoxicated with the performance.
Fine. For example, for somebody who runs an ETF whose hands are tied, other than for quarterly rebalances, what's the thought process when you're sitting on a Micron in the Joe T and you're essentially forced to sit there and just watch it go parabolic, knowing that you can't do anything about it? But if you owned it personally, you certainly would have more options. I'm wondering what the pro versus average Joe mentality would be in a name like that.
So you're going to find my answer interesting. First of all, it's 500 U.S. large cap companies. So you could make an argument that the strength of the balance sheet is a little bit different and the volatility levels are also different. But guess what? When I look at it and I say to myself, okay, what exposure do we have currently? I wish we had more momentum. I wish that we were a little bit less quality. We're 50% momentum. We're 50% quality.
Look at
Quality's not getting rewarded so far year to date. Quality's up, I think, 3%.
Because you have,
while momentum is up nearly 20%.
But that's because you have cap goods are exploding. You have regional PMIs that are north of 55. We haven't seen that in forever, and that has everything to do with AI and the data center and the grid and power. I feel like I say it every single day. That's where the momentum is. But this is in the second inning. You've got Amazon, Google, and Microsoft with $1.3 trillion of cloud backlog. We are short everything, and that's where the dollars are going. That's where the earnings are coming in. So I know you're in momentum. I think that's great.
50-50.
But I think this whole theme is in very early innings, and based
on what you're saying, I should probably be 60-40 momentum or 70-30 momentum.
It's never bad to own quality, though, Joe.
I understand that. But Scott asked a great question. In the environment we're in now, you're kind of trying to challenge yourself on how long can this environment continue? And if the current environment continues as it exists right now, to your point, Steph, then you probably want to be 60-40 momentum or 70-30 momentum.
But that's why we cite all these numbers. These are huge, $1.3 trillion in cloud backlog from 3 companies. That's enormous.